Let me tell you about a conversation I had with a man I'll call Eric because it explains why most people never understand how the tax system really works. Eric had a good income, he saved carefully, he stayed out of debt, he did everything people are told responsible adults are supposed to do. And yet every April the same thing happened. He would open his tax return, stare at the number he owed, and feel like the government had reached into his account and taken the first bite out of everything he had worked for. Then one year, something strange happened. Eric invested money into a small operating business. The business bought equipment, paid for software, hired help, and spent money preparing for growth. A few months later, when his tax return was finished, Eric called because he thought there had been a mistake. His taxable income had dropped. Not because he earned less, not because he hid money, not because his accountant found some shady loophole. His tax bill fell because the money he invested went into activities the tax code was designed to reward. That is the part most people never hear. The IRS is not simply a collection agency waiting to punish you. The tax code is also a giant incentive system. It tells you in thousands of pages of rules what the government wants more of. More businesses, more jobs, more housing, more domestic energy, more investment, more economic activity. And when the government wants something badly enough, it does not always write you a check directly. Sometimes it pays you by allowing you to keep money that would otherwise have gone to taxes. But there is a warning. These investments are not magic. A tax deduction does not turn a bad deal into a good one. A tax credit does not erase business risk. And a large write-off can become expensive if you chase it without understanding the investment underneath it. The people who win with these strategies do not invest just to save taxes. They make investments that already make economic sense. And then they structure them in a way that allows the tax code to help pay part of the cost. That is the difference. Before we get into the first investment, you need to understand one simple rule. Every major tax break exists because someone in government wanted a certain behavior to happen. Think about it. If the country needs more jobs, it rewards businesses. If cities need more housing, it rewards real estate development and rental ownership. If the economy needs reliable domestic energy, it rewards energy production. The tax code is not random, it is a map of economic priorities. Most people look at that map only once a year when they file their return. By then it is too late. The year is over. The money has already been earned. The decisions have already been made. Their accountant is not planning anymore. The accountant is simply reporting what happened. Wealthy investors do the opposite. They look at the tax consequences before they move the money. They ask, if I buy this asset, what deduction comes with it? If I invest in this company, what credit may be available? If this investment produces income, how will that income be taxed? If I sell later, can the gain be deferred? They do not wait until April to discover their tax result. They build the result into the investment from the beginning. That brings us to the first path. Number one, investing in a business, including a small business or even a legitimate side business. This is where the tax system begins to look completely different. Most employees live in a world of gross income. Their paycheck arrives, taxes are withheld, and whatever remains is what they have left to spend. A business owner operates in a world of net income. The business earns revenue, subtracts legitimate business expenses, and pays tax on what is left. And this is exactly why business ownership is so powerful. The government needs businesses because businesses create jobs, buy equipment, rent property, purchase services, and keep money moving through the economy. Small businesses are especially important because they employ a huge share of the workforce. So the tax code gives business owners something employees rarely have: the ability to invest before tax is calculated. Now let us start at the beginning. Suppose you are considering launching a business. Before you earn your first dollar, you may already be spending money. You research the market, you test a product, you pay for legal help, you form an entity, you build a website, you study suppliers. You travel to inspect a location, you pay for accounting and organizational work. The tax rules may allow up to $5,000 of qualifying startup costs and another $5,000 of organizational costs to be deducted, subject to the applicable requirements and limitations. Think about what that means. The government is effectively saying, we know starting a real business costs money. If you are willing to take the risk, we may allow part of that cost to reduce your taxable income. And once the business is operating, the opportunity becomes much larger. Marketing can be deductible. Advertising can be deductible. Software can be deductible. Professional fees can be deductible. Equipment may qualify for depreciation or accelerated write-offs. Certain research and development activity may produce tax benefits. Retirement contributions made through the business may reduce current taxes while helping you build long-term wealth. And depending on the type of business and your taxable income, the qualified business income deduction may allow an additional deduction of up to 20% of qualifying business income. But here is the tripwire. A hobby is not automatically a business. Buying a laptop does not make every personal expense deductible. Taking a vacation does not become business travel because you answered one email at the hotel. Putting a logo on your car does not turn every mile into a write-off. The expenses must be ordinary, necessary, documented, and genuinely connected to a real profit-seeking activity. That distinction matters because the tax benefit is not payment for pretending to run a business. It is payment for actually taking business risk and creating economic activity. So the counter move is simple. Do not start with the deduction. Start with the business case. What are you selling? Who is the customer? How will the business make money? What expenses are truly required? What records will you keep? What assets will help the operation grow? Then once the business makes sense, structure the spending so you receive every legitimate tax benefit available. That is path number one. But the second path is where the numbers can become much larger because it allows you to claim deductions on an asset that may be rising in value at the same time. Number two, real estate investing. A man I once spoke with owned a small rental property that put several $100s into his bank account every month. He assumed that because the property produced cash, the entire amount would be taxable. Then his return was prepared. Mortgage interest reduced the income. Property taxes reduced the income. Insurance reduced the income. Repairs reduced the income. Management fees reduced the income. And then came the deduction that confused him most of all, depreciation. He looked at the number and said, "How can the property be depreciating? It is worth more than when I bought it." That question is the reason real estate has created so much tax-advantaged wealth. In the real world, a well-located property may appreciate over time, but for tax purposes, the building portion of the property is generally treated as if it wears out. The owner may be allowed to deduct that decline in value over a prescribed period, even though no check is being written for depreciation each month. It is a non-cash expense, and that changes everything. You may receive real cash from rent while reporting far less taxable income after depreciation and other expenses are applied. Read that again. The bank account can move up while the taxable income moves down. Then there is a more advanced strategy called cost segregation. Normally, a building is depreciated over a long schedule, but a cost segregation study separates certain components of the property into shorter life categories. Items connected to flooring, fixtures, electrical systems, landscaping, equipment, or other qualifying components may be depreciated faster than the main structure. Why does that matter? Because a deduction received today is generally more valuable than the same deduction received many years from now. Cost segregation can pull future depreciation forward. For example, a $1 million property might generate more than $200,000 of additional first-year deductions, depending on the property, the study, and the rules in effect. Now imagine the investor financed most of the purchase. The bank provided a large part of the money. The investor may still be entitled to depreciation based on the qualifying tax basis of the property, not merely the amount of cash placed down. Then, years later, another tax benefit may appear. Suppose the property has risen sharply in value and the owner wants to sell. A normal sale may trigger capital gains tax and depreciation recapture. But under the right conditions, a properly structured Section 1031 exchange may allow the owner to defer gain by moving from one qualifying investment property into another. Notice the word defer. The tax is not necessarily erased, it is pushed forward. But that deferral can be enormously powerful because the money that would have gone to taxes remains invested. The investor sells one property, rolls the proceeds into a larger property, receives new rental income, takes new deductions, builds more equity, and repeats the cycle. This is how a single down payment can become the first step in a portfolio that grows for decades. But once again, there is a trap. Real estate does not become a good investment simply because it comes with depreciation. A cost segregation study can produce a large deduction, but that deduction may be subject to passive loss rules, at-risk rules, recapture, and limitations based on your tax situation. This is where people get hurt. They hear that a property can create a $200,000 deduction and stop asking whether the property itself is worth owning. That is backwards. The deduction is the bonus. The investment must still stand on its own. So the counter move is to analyze real estate in the correct order. First, study the property. What is the true rent? What are the operating expenses? What happens if the property is vacant? How much cash will remain after debt service? What major repairs are coming? Is the location improving or declining? Then study the tax treatment. How much of the purchase price is allocated to land? What depreciation is available? Would cost segregation help? Can you actually use the losses? What happens when you sell? Is a 1031 exchange realistic? When both sides work, real estate can do something extraordinary. It can produce income, build equity, appreciate, and reduce taxes at the same time. And now we come to the third investment. This is the one that causes people to lean forward when they hear the numbers. It may allow a large portion of an investment to become deductible in the first year. It may also allow part of the future revenue to receive special tax treatment, but it is not for everyone. Number 3, qualified oil and gas investments. The reason is simple. Domestic drilling is expensive, uncertain, and essential to the broader economy. A company can spend heavily on labor, fuel, site preparation, and equipment before knowing how productive a well will be. To attract private capital into that risk, the tax code gives qualifying projects unusually strong incentives. In some properly structured deals, up to roughly 85% of an investment may become deductible in the first year, depending on the expenses incurred and the investor's tax situation. Imagine investing $100,000. A qualifying project may pass through an $85,000 paper deduction on a Schedule K-1. That deduction may reduce taxable income subject to the specific tax rules that apply to the investor. This is not the same as receiving $85,000 back. That is one of the most important distinctions in this entire video. A deduction reduces taxable income. The actual cash value depends on your tax rate, your ability to use the deduction, the character of the loss, and your overall tax position. But even after that distinction, the benefit can still be substantial. The first major incentive is the intangible drilling cost deduction. Drilling a well requires labor, fuel, site preparation, chemicals, hauling, and other expenses that do not necessarily leave behind a physical asset with resale value. In many businesses, intangible costs must be capitalized or deducted over time. Qualified drilling activity may receive far more favorable treatment, allowing a large portion of those costs to be deducted much sooner. Then there are tangible costs: equipment, machinery, pumps, storage systems. The physical parts of the drilling operation may qualify for depreciation. So the investment may generate deductions from both the intangible side and the tangible side of the project. That combination is rare, and there may be another benefit after production begins. Then there is the percentage depletion allowance, which may allow qualifying investors to exclude a portion of gross income from taxation subject to detailed limitations. In the simplified example, 15% of qualifying revenue may receive this special treatment. So the investment can be tax advantaged on the way in and receive reduced taxation on part of the income coming out. But this is exactly where the biggest danger is hiding. The tax benefit arrives on paper. The investment risk is real. That is why the largest deduction in this video demands the most due diligence. Never begin with the sentence, "How much can I write off?" Ask who operates the project, how many wells the team has drilled, what the historical results were, how conservative the reserve estimates are, how much of your money goes into actual drilling rather than fees, how long the capital will be locked up, and whether your own tax situation can use the projected deduction. Now let us step back, because the 3 paths we just covered look different, but they all operate on the same principle. Business investing rewards job creation and economic activity. Real estate investing rewards housing, development, and long-term ownership. Energy investing rewards domestic production and risk capital. In every case, the government wants private investors to do something the economy needs, so it lowers the after-tax cost of doing it. That is what people mean when they say the IRS will pay you to invest. The IRS is not mailing you free money for buying a random asset. The tax code is allowing you to redirect part of what you might have paid in taxes into activities the government has chosen to encourage. But this strategy only works when you respect the order. Economic value first, tax value second. If the asset is bad, the deduction will not save you. If the operator is dishonest, the tax benefit will not recover your capital. If the business has no customers, writing off the expenses still leaves you with a failed business. If the rental loses money every month, depreciation does not pay the mortgage. If the well is dry, the deduction may soften the loss, but you still lost money. Never spend $1 solely to save 30 cents in tax. The goal is not to create the largest deduction. The goal is to create the largest amount of after-tax wealth. Those are not the same thing. And this brings us back to Eric. When he first saw that lower tax bill, he believed the accountant had discovered a trick, but there was no trick. Eric had simply crossed from one side of the tax system to the other. Before, he earned money and paid tax before deciding what to do with what remained. Now, part of his money was being invested into a real business before the final tax bill was calculated. He was no longer asking only, "How much did I make?" He was asking, "What did I build with it?" That is the question the tax code often rewards. Did you create a business? Did you buy productive equipment? Did you provide housing? Did you improve a property? Did you fund domestic energy production? Did you put capital at risk in a way that supports the economy? When the answer is yes, the government may allow deductions, credits, deferrals, or special tax treatment. And once you see that pattern, the tax system stops looking like a mystery. It becomes a set of incentives. So here is the practical move. Before the end of the year, do not ask your tax professional only one question. How much am I going to owe? Ask a better set of questions. What investments am I already planning to make? Which of them may qualify for deductions or credits? Should the investment be made personally or through a business entity? Will the deduction be usable this year? Will it be suspended? Could it create recapture later? What records are required? What is the economic return before tax? What is the return after tax? And what happens if the investment performs worse than expected? Those questions turn tax filing into tax planning. And tax planning must happen before the transaction, not after it. Once December 31st passes, many of the best opportunities for that year disappear with it. The return you file in April is only the scoreboard. The game was played months earlier. Let me leave you with one final thought. Most people believe the tax system rewards income. It does not. Income is usually what the system taxes. The system often rewards ownership, investment, risk, development, and production. So do not chase deductions. Build assets. Do not buy tax shelters you do not understand. Invest in real economic value and then use the tax code exactly as it was written. Because the people who legally pay the least are rarely the people who know one secret loophole. They are the people who understand what the government wants, invest in those areas intelligently, document everything, and plan before they move. And once you learn to do that, taxes stop being only an expense. They become part of the investment strategy. If this changed the way you look at taxes, subscribe before you leave. Every week, we break down the financial rules, hidden incentives, and quiet mistakes that cost ordinary investors real money. And remember, the goal is not to beat the system. The goal is to understand what the system is already paying you to do.